the market update. And then we'll look at the awards for May. So Home Value Index shows Sydney recovery and Brisbane takes over from Canberra as the second most expensive capital city. Very interesting because obviously that means that, there's movement in the leaderboard with regards to property prices. So very, very interesting. So CoreLogic's Home Value Index rose 0.8% in May, the 16th consecutive month of growth and the largest monthly gain since October last year. So very much still Australia property market in an upswing. Okay, the mid-sized capitals continue to lead the pace of growth, with Perth 2%, Adelaide 1.8%, and Brisbane 1.4%. The remaining capital cities recorded milder conditions, with 0.6 lift in Sydney, decline 0.5 in Hobart, and 0.3 fall in Darwin. CoreLogic Research Director Tim Lawless said extremely low levels of available stock across the strongest markets provide the best explanation. We are still running at extremely low stock levels. The number of properties available for sale in Perth, Adelaide remain more than 40%. 40% below the 5-year average. And this time of the year with this time last year with while Brisbane listings are 34% below average. There's a changing in the guard, of course, with Brisbane overtaking Canberra as having the second highest median dwelling value across capital cities, as I've mentioned, overtaking the Melbourne median. This was partly compositional, with the overall median dwelling value in Melbourne being weighed down by the high concentration of relatively cheap units. Sydney values recover. Good old Sydney. Upper quartile home values have generally shown the lowest rate of growth over the past year. This trend is apparently across every capital city except Darwin, demonstrating stronger conditions across the more affordable price points of the market. So Sydney, 0.6 for the month, 1.2 for the quarter, 7.4 growth last 12 months. Melbourne, 0.1% growth, negative 0.2 for the quarter, and a low 1.8 for the 12 months. So Melbourne has balanced out because of those units. Brisbane, 1.4 growth, 3.9 for the quarter, 16% for the last 12 months. Adelaide, 1.8, 4.3, and 14.4 respectively. Little old Perth, 2% growth for the month, staggering. 6.1 for the quarter, unbelievable, and 22% growth for the last 12 months. Once again, folks, what a great thing to use in your prospecting calls. Great news. Property prices have increased by 22% across the board. Do you want to know how much money you've made on your property? I can send you an e-appraisal, or I can come and do a physical appraisal. Let me know what suits you best. So you're giving them a choice. You're not asking do they want one. You're just giving them a choice. But that's pretty unbelievable when you consider 22% growth. It's pretty phenomenal. Combined capital cities are 8.8 for the year, 6.8 regional, and the national changes are 8.8% for the month, 1.9 for the quarter, and we've had an 8.3% growth nationally. That is it's unheard of, being that it's 16 months in the making, and quite unbelievable when you consider, obviously you know, the cost of living having increased so much and the prices being what they are. I'm just so bloody glad I've invested in property in the last 10 years, because if you haven't, you're up shit creek without a paddle. I wonder about the poor young'uns and, you know, 20s and 30s people, how they ever going to afford to buy, but they do, funnily enough. Some of them. Okay, pace of growth across Australia, rental markets, CoreLogic, a national rental index rising 0.7 in May and lowest monthly change since December last year. With rents rising at a faster pace than home values, gross rental yields have continued to trend higher, rising to 3.56 across the combined capitals, the highest gross yield since August 2019. So Perth growth, so annual change in rents. Perth 13.5%, Melbourne 9.7%, Adelaide 9.5%, Sydney 8.9%, and Brisbane 8.2%. So once again, Perth leading the way with annual changes in rent, 13.5%. Annual change in units, 14.7%. So equally as obviously strong. Okay, gross rental yields. I thought I'd mention this time. Obviously, regional has better rental yields. So if you're looking to buy a property, definitely regional is got better return on investment for your dollar. Lower interest rates. So if you're looking for a property, talk to the people in the regional areas. Jelena would be one that's standing out. But yeah, regional Western Australia, 6.1% return on investment. Regional Northern Territory, 7.3%. So yes, you might not have as great a capital gain, but certainly in a city. Perth, 4.5% return on investment. Well, that equals to what you would get in fixed deposits. So that's a pretty good return on investment in my book. I'd prefer 5, but I can do it 4.5. Adelaide 3.8 and Melbourne 3.6. Brisbane 3.8. Sydney lagging on the return on investment front of 3.1. Okay, let's look at what's driving the market. Excuse me. The trend, not the trend, the trend in housing values and activity continues to be insulated from the combined effects of high interest rates, cost of living pressures, and deeply pessimistic consumer sentiment levels. To say the housing market has been resilient is an understatement, Mr. Lawless said. Housing values are continuing to rise across most areas and housing types, with growth acceleration in some markets. The common denominator remains a mismatch between housing supply and housing demand. So there's no rocket science there. Supply and demand, low supply, high demand, very fierce market, both rental and sale. Available housing supply based on the number of homes advertised for sale over the past 4 weeks remains well below average. Capital city listings are 16% below the previous 5-year average, nearly 2% lower than a year ago. So still on that downward trajectory of supply. Demonstrated demand based on the quarterly number of home sales has tracked 7.2 above the previous 5-year average and are 2.8% higher than a year ago. So sales, this is interesting. Even though the inventory is lower, sales are higher, meaning that there's huge demand for immigrants, people, you know, moving, upsizing, downsizing, all of that jazz. Demonstrated demand based on the quarterly number of home sales has tracked 7.2 above. So it's this disconnect between supply and demand that is trumping the downside pressures from interest rates, high inflation, and low sentiment. I'm going to say that again. This disconnect between supply and demand is trumping the downside pressures from interest rates, high inflation, and low sentiments. I would actually say that we don't have high interest rates, folks. And I believe that interest rates need to go up to sort this problem out. You may not call it a problem, but in my book, this is a bubble that, if it continues, bursts. And what happens when a bubble bursts? We have financial crises, all right? And that is not conducive to anybody in any state or territory. So they need to put some water on the fire. A supply response still seems some way off. Of course, there's no properties being built. With new dwelling approval once again dipping in April, national approvals are up 3.5 on the same time last year, but 23% below a decade average. Horrifying. Across multi-unit sector, approvals are almost negative 44% below a decade average. We are critically low on supply. Okay. Eventually, housing demand and supply will converge, driven by slow population growth and eventually a ramp up in residential construction activity. In the meantime, we can probably expect further upward pressure on housing values alongside a further erosion in housing affordability. That just goes one with the other, even as interest rates stay higher for longer. Okay. Perth, 3,438 properties for sale in Perth. Let's break that down. 1,982 houses. 1,982 houses available for sale in Perth. That's nothing. Units, 950. Land, 506. So obviously a very low inventory in Perth. 681 properties leased last week, which is 7.6% higher than the previous week, which is good. 18% higher than 4 weeks ago and 1% higher than a year ago. So very slight increases in properties available for rent. A quick look at New Zealand, because this is interesting. Home value across the Aotearoa, New Zealand, has completely petered out in the past 2 months, with values dipping by 0.2% in May after a minor 0.1% fall in April. So Auckland leads the slowdown as national prices dip again in New Zealand. Below, CoreLogic House Price Index shows that an average property value across New Zealand is 931, up by 1% from a year ago, but still roughly 11% below the peak after COVID, the COVID peak. Below the recent stagnation, showing moderate speed condition, Auckland dropped to a notable 0.8 in May after a 0.6 fall in April, while Wellington saw a 0.6 fall and Tauranga dipped 0.5. By contrast, Christchurch rose by 0.5% and Hamilton, Dunedin both saw gains of 0.8. So it is a parallel market, New Zealand, even though it seems to be performing differently at different times. But it's quite strange that they reacted and they reacted a lot quicker than us, but they did have, it was ridiculous. I think their growth was something like 49%. It was literally the biggest spike I'd ever seen in my 22-year career. It was 39% of 49%. It was staggering, which was once again unfathomable, because that type of balloon bursts, and then they definitely had a downturn. Obviously, their downturn has gone for at least a year now, because I spoke to a New Zealand company, Mike Perro Real Estate, who are now being taken out by Rain and Horn. And that was that a year or two ago, Anita? 1 year ago. and they were experiencing, they had already started experiencing quite severe downturns, and the real estate agents in particular were feeling a lot of pain, trying to offload properties, weren't selling anything, prices had dropped. So the higher it goes, the further it has to fall. And this is just based on experience. And I know that the sentiment with real estate agents is, oh, it can't happen here and it won't happen here. And they say that every single time. So all I want to say is go cautious, ride the wave, get the make hay while the sun's shining. It's certainly not the best market for real estate agents, having that you are struggling to find stock, but when you find it, you're selling it, probably underselling it, with all due respect to all of you. And the reason I know that is because my auction calls are the lowest they've been in 20 years. And that's because agents can sell them on their own, off market, or to the first offer. But the last two auctions that I did, and one in Bigton, we got 300,000 more than the reserve price and than a pre-auction offer, which the sellers would have accepted. 300,000. And another one was 320,000, which was in East Fremantle. Same. We got pre-offers, and we still took it to auction and ended up getting 300,000. This is real, okay? This is actually real. If you want to find out the details, call Andy McIntyre from Mint Real Estate. Their sellers are gobsmacked, and it just shows, are we underselling? There's no doubt we are. Let the market determine the price. It doesn't have to be a 4-week campaign. Do a 14-day campaign, a 10-day campaign. But let the market determine the price, because that's what we paid to do. Not that I want to see buyers paying exorbitant figures. That's not what this is about. It's about letting the market run, and it's about letting it find its own place. Enough from me.